Warm greetings. In this short presentation, I want to convey the idea of what exactly is the QTP program, Qualified Tax Products, what is being sought, how and who it can benefit, and what it will do for different segments of the business community. And you may fit possibly in one or more of those. All right, so this will be addressed to several different categories of individual, whether you're an investor, an investment advisor, a project developer. This will highlight some of the features and benefits of what the QTP program really is. It's really quite interesting, so I hope you stick with me, and I thank you for your attention. This is Mark Emery Boswell, and what we're talking about here is a presentation, a product that will cater to the needs of investment fiduciaries, wealth managers, and people who want to provide custodial accounts for our Pasterra Funds, as we call them. Pasterra, people ask, where does that name come from? Well, paz is the Latin term for peace, and terra, of course, is the earth. So peace on earth funds has kind of a nice ring to it, doesn't it? So we're also talking about money managers who want to possibly manage Pasterra Fund money with anywhere from $50 to $100 million per fund to manage. We're looking at business partners, joint venture partners who might be looking to borrow money directly from the funds or indirectly through finance partners, lending money for real estate projects like hotels, could be residential developments, office buildings, as well as master franchise holders. There's all types of applications for this. Basically, any legitimate business purpose that needs to raise large amounts of capital for long-term financing would benefit from this product. Okay. So the QTP Qualified Tax Product Funds are a new tax-deferred financial product. And this product is offered through typically wealth advisors, investment advisors, and right now these products are ready for the rollout phase. Okay, what do we mean by that? Let's take a look at the growth curve of new ideas, new concepts, and new products. You'll see here that on the left, you'll see images, and each of these images represents another product, another document, or a video, or a diagram of some sort that enables us to drill down on the specific points that are being made in the presentation. Okay, I'm not going to do that just for the purposes of brevity. In this short presentation, I want to keep it as short as possible. But if you're interested and we communicate further, we'll send you the URL link to access this presentation, and you'll be able to either drill down on these yourself, or we can do it in a follow-up session where we have a chance to go over it with you. That would probably be the best case scenario. But for now, let's just look at this document. You look at the left, any new product being developed and rolled out to market starts at the gestation phase, where the idea, the concept is kind of formalized, the business plan is put together, certain levels of prototypes are developed and tested in the marketplace, and once those prototypes have been perfected, market research has been done, collaboration, marketing, funding, those type of things have all come together. Then comes the rollout into the market. And that's where we're at right now. We're in the rollout phase, and we're poised to jump right into the rapid growth phase of this growth curve. Okay? So that's where we're at in the development stages. So these QTP products are, in essence, a qualified investment fund. All right, we're talking about a qualified investment fund, setting up an investment fund. And this fund will issue tax-deferred debentures, which are generally called bonds, of course. And the bonds are issued through a patent-pending escrow process to investors, individual investors, or institutional investors, or corporate investors, okay, wishing to avoid high taxes which are generated from the sale of valuable assets, okay? The taxes are deferred by investment in a QTP product, and that's the major advantage of this product. So therefore, the seller of that asset is able to reinvest the proceeds of a sale of that asset into a long-term tax-deferred QTP fund, which is much better than annuities. Okay, and we'll talk about that. So the net benefits over annuities are that the QTP product investment actually freezes the capital gains taxes which might otherwise be due on any asset sales. Okay, annuities don't do that. It's a huge advantage. All right, and then this amount can compound tax-free, as does the annuity, but it has a lower overall effective tax rate than annuities. And you'll see why in a second. Okay, the investment management is top rated. Our funds are managed with top fund managers like PIMCO, Allianz Global Investors, JP Morgan Asset Management, Loomis Sales and Company, and Lazard Asset Management, just to name a few, okay? So the management is top quality. All right, now at the moment, QTP financial products have momentum in the industry, okay? The product's features for investment professionals have been recognized by the top industry leader, Source Media, which is a corporate conglomerate publishing company with 15 financial magazine publications. They have more than 2 million investment professional subscribers, and their publication, Financial Planning Magazine, together they have committed to promote the QTP products via industry innovation sessions. These are specialized product rollout introductory seminars to invited qualified financial professionals that is done by Source Media in these rollout sessions, these product rollouts, all right? And that's supported by magazine ads that go out to all the industry professionals nationwide, supported by articles for information and education on the benefits for an investor to choose a QTP product over other products. And that's all wrapped up in a national rollout, which can be done in 10 major cities. And so this can be done on a fund-by-fund basis, okay? One of those funds may be your fund, or the fund that you sponsor to generate capital for your project, if you are in fact a project developer, business expansion manager, or principal. Okay, so you get the idea. So QTP will build an investment advisor business quicker than any other investment product that is sold today. And here's 3 reasons why. All right, first of all, the advisors can earn another 48% in annual fees by selecting the QTP products, while at the same time, their clients also increase their after-tax return by a similar amount. Okay, so that's huge. That's absolutely huge. This product creates a new direct marketing channel, or multiple channels, to wealthy investors seeking real estate. All right, it facilitates the sale of property by eliminating that capital gains tax hurdle or shot in the arm. All right. Thirdly, advisors will obtain new investments from existing clients that have valuable assets not being managed by the advisor currently. So this brings in new business from their current book of business, and it creates marketing channels to new clients to expand their client base. All right, so the investment advisors absolutely love this product. All right, the investment product wholesale distributors who will represent QTP investment funds, they want this product in order to get into investment advisor clients whose needs perhaps were already served by other product providers, but when it comes down to it, the product choice or selection is very limited. All right, and when it comes down to it, really, how many annuity companies do advisors really need to have to serve their clients? Not very many. And they're really quite limited in what they can offer. And so this product presents a whole new horizon of opportunity for the investment advisors as well as the investors themselves. All right, so that's exciting. All right, this unique patent-pending financial process, it solves several problems. All right. First of all, it solves a serious tax dilemma that sellers have when they are subject to large taxable gains on capital assets, okay? It solves the problem of advisors having a stagnant book of business. QTP is the best tool for advisors to build assets under management much faster than they would otherwise with traditional products. And also, the QTP Pasterra Funds provide capital to commercial finance partner lending operations. All right, so we can create a whole new genre of commercial lending. And of course, we're talking about raising long-term, low-cost capital for your project, so you can now start to see how the pieces fit together here. All right, long-term investment creates longer investment cycles, so typically anywhere from 5 or 10 to 20 years. And this allows QTP's investment horizons to match the largest insurance companies, giving us much more flexibility and leeway to be conservative and risk averse. Okay, we use the same top money managers and have greater regulatory flexibility to lend on all asset classes to help borrowers, project developers, meet all their needs with one lender. Okay? So that makes perfect sense, I hope. Now, qualified tax products are already recognized in the Financial Industry Innovation Session, which I've referred to earlier. And this is with the biggest publishers in financial services like Financial Planning Magazine. And they have already recognized this product as being first to design, the nature of this product. So we're the first to design with a successful, non-obvious, but patentable subject matter. And the hurdles are cleared at the U.S. Patent Office, where we're ready to build potential monopoly protections with patents on this process, okay? So that means that there's no competition. It's a proprietary concept, which also insulates advisors from the liability that they could stand to suffer with the anti-fraud rules, all right? What this process does, it streamlines a series of novel individual steps for the investors, and it requires no material advisor relationship on the part of investment advisors. Okay, if you're an investment advisor, you know what I'm talking about. All right, so what this means is the whole process is simplified. The QTF offering memorandums cover the applicable tax code, which reduces the need, the costs, the additional delays which could be incurred by having the need to go outside for your material advisor's opinions, get the legal and accounting support, and so this fast tracks the investment process with safe, non-listed transactions that are not reportable to the IRS. That's huge. That's very important. Okay, now, recently it's been determined that financial products that are novel and which streamline processes are now patentable. And this has been the case since 2001. The case of State Street versus Signature Holdings Group is a landmark case on that subject matter. We can provide you more information on that at the appropriate time. Now we have a market edge. It took QTP Financial Product Development $5 million of research and development to create this proprietary method of investment and escrow processes. And we've got more products to introduce. All right, this is a proven product. There have been 5 generations of test products doing real business and mortgage finance. There have been, in total, over 322 tested transactions with a successful review of 8 cases by the IRS at the field office level without further review. And the tax-deferred transactions were instantly recognized and accepted without discussion. Okay? Proven product. And of course, it presents a huge tax savings to investors who are in that capital gains situation. They can realize a savings of up to 48% of the principal amount of the asset. That's almost half the asset. Could otherwise be lost to taxation. We can save that with the QTF fund. Okay? All right, so from the innovation session to magazine ads to live events, QTPs have been seen and acknowledged already as a product innovator in the financial industry. And we've got plenty of material to support that. So let's look at a simple example, all right? Let's look at Sam, who is a California independent investment advisor with TD Ameritrade. He attended one of our 10 city tour events sponsored by Financial Planning Magazine and Source Media, and he decided to consider a Pasterra Fund for one of his clients, who is a California resident as well. His client inherited a small fishing property in the Sierra Mountains in California with a current value of about $3.3 million. All right. Now, if the property was sold and reinvested into an annuity, for example, or a mutual fund or a tax-exempt U.S. Treasury bond, with Sam, the investment advisor, the client is looking at roughly a $1 million tax bill. Not too much fun. So the net investment with Sam would be the sale proceeds of $3.3 million minus the $1 million tax bill, leaving only $2.3 million to invest with Sam. And Sam earns a percentage on that annually for about $47,000. Now, in the alternative, with a new Pasterra fund, they could do this. If Sam has then made the investment into the qualified tax product, like a Pasterra fund, the investor is qualified to receive a freeze on all taxes from the sale for as long as 30 years. So the investor would be allowed to retain the $1 million, which would have been otherwise paid in taxes. He saves that by using the Pasterra fund investment, and he earns interest on it for up to 30 years before any taxes are due. So simple math shows a 25% increase in the amount of interest he will earn over the life of the investment. Plus, he gains from the additional compounding of the interest, which creates the best after-tax return compared to any alternatives available through his investment advisor, Sam. All right, so using the Pasterra Fund, the investor gains $1 million more principal to invest, plus the interest, plus the compounding on the interest for up to 30 years. Sam's assets under management increase substantially, giving Sam an annual fee of 35% more than what he would have had otherwise. You think he's happy? You think his client's happy? This is win, win, win all the way around. It's extremely powerful. So using industry-leading marketing channels for the Pasterra rollout with media partners like Source Media and Financial Planning Magazine, we can see very rapid market adoption. Okay, marketing is not an issue. All right, there are direct channels through special events like Disrupt, which are put on by Financial Planning Magazine for disruptive financial innovations for advisors. And aren't we in the perfect time for disruptions? We're looking at huge disruptions in the financial and economic world with blockchain technologies just going crazy, hashgraph technologies superseding that, political disruptions, I don't need to tell you about that. We're in the age of disruption, and this product fits right in with the status quo basically being put on its ear. Okay? There's a new way of doing things, new ideas, new channels, new opportunities. All right? And that also gives us new direct channels. And with that comes advisors' advertising programs with real estate offices, national networks, business brokers, other affinity partners that are all tied into these marketing sources. All right, and this also gives us institutional exposure to captured advisors and their entire networks, all right, for mass marketing, mass exposure, mass distribution of future product releases, in addition to the current ones that we work on. All right, so market adoption can be very rapid, and rollout it's there for us. It's there for you. All right, so the USA and Latin America are ready. All right, there are new SEC rules designed for QTP. I'm not going to get into the weeds on this, but when we get the opportunity, over on the left here, you can see a video. It's an excellent video. It's a short webinar that's put on that gets into the advantages of the 506C regs and rules on that, and that's quite enlightening and really quite exciting once you understand the impact that has on this type of product for fundraising. Okay, so we'll save that for another time. The new tax bill just went into effect in January, signed by President Trump just before Christmas, has some huge advantages for QTP products. There's a territorial tax provision now that is completely new, never existed before, and that relates to foreign interest deduction to offset U.S. QTP fund income. All right. Again, we won't get into the weeds on that right now, but just understand that there are provisions in the new tax bill that allow for foreign interest deductions and also foreign interest earnings to be tax deductible, okay, or not taxed, in other words, all right? And so that will come into play when the fund is actually structured for the Panama Company clients in Central America. There will be certain advantages that will be gained there. Okay, we can talk more about that another time. So there are favorable interest rules for foreign subsidiaries, is what I'm getting at. The tax bill elimination of all 1031 tax-free exchanges is huge. And if you're not familiar, until this new tax bill, there had always been a 1031 exchange exemption from taxes. In other words, if you exchanged one property for another of equal or greater value, then there would be no capital gains taxes levied. All right, that exemption is gone. All right, no more. If you follow cryptocurrencies, you've heard talk about that and how it affects cryptocurrencies. And people now are having to track their activity and be able to, report possible capital gains or losses on all of their transactions. And the same goes for other assets. Okay, so what does that do? That means that there's a higher liability for capital gains taxes, which creates more of an opportunity for this product. Simple. Okay? So right now, the economy is returning to its peak values from 2007 in the capital gains arena under the Trump tax bill, which is now law. Okay, so the timing could not be better. Capital gains are back. Bad news for some people. It's good news for us. Okay, and this is going to be on the minds of real estate investors. This creates the demand we've been waiting for to roll out the QTP products once again. All right, so we now have an increasing market for capital gains solutions from investors who want long-term investment horizons. Okay? So this is great news. So who are prospective Pasterra Fund sponsors and potential partners? All right, these funds are intended to raise from $100 million to $500 million, typically. And the cost to sponsor one is somewhere between $2 and $3 million. Okay, this includes formation of the fund, initial startup, legal expenses, formation costs, marketing costs. A big part of that is marketing, rollout and launch of the new fund. All right, investors are in a fund. A fund sponsor is allowed a low-risk, special, accelerated payback in the first 5 years of the fund operations. And this comes under standard U.S. Securities and Exchange allowances for early repayment of fund startup costs. So the U.S. SEC allows the fund to pay fund sponsors back their initial capital. All right, now sponsors can choose either a debt or equity participation under U.S. returns under tax-free Portfolio S that can provide tax exemptions for the interest earned by foreign investors. Equity partners can structure a profit share strategy as a sponsor of a Pasterra fund. So there's different ways to put this together, depending on what an equity partner might have in terms of goals and objectives. All right, but here's just an idea of some typical Pasterra fund sponsors and partners, of what types of entities or activity that we're looking at. We're able to sponsor our own funds in the future, so that brings some interesting possibilities. But this typically is attractive to commercial lenders, to real estate investment and development groups, business development and franchise expansion projects. A master franchise holder might want to develop, a number of new franchises. This could fund that entire operation. Trust fund managers looking for new alternative products to diversify into. Investment managers and advisors can certainly see some benefit in participating one way or the other. And of course, private family offices for high net worth individuals are always looking for exciting new products. So these are just some typical categories of potential partners for the product that we've created here. All right, now on the development curve, We went over this earlier. We're right at the stage now where we're setting up a company in Panama to service the Latin American market. All right? And this will be the platform that we roll out for this region of the world. And when looking at the development process and the growth curve, the development process, there have been actually 5 different prototypes that have been actually used in the marketplace. And you can kind of see for yourself here a short list of some of those, starting back in 2001. This has been used in mortgage situations. Papa John's Pizza in Russia expanded a number of restaurants using this process. And so there's been quite a history on this already. It's proven, it's been tested, it's been applied in real situations and been very useful, functional, to the point that we have it right now. As I mentioned, 5 years and about $5 million have been put into it already. A fair amount of value has already been created for the Panama company. We'll talk more about that in a minute. Okay, but you can see the Qualified Investment Fund service mark was established in 2008. Source Media Innovation Session Tax Products was done that same year, as was the Qualified Investment Services Company. Qualified Investment Fund service mark established that same year. 75 patent applications have been put in, and the patent claims are sealed with the trade secrets for this process. Another 50 patent claims have been sealed subsequent to that, and the Avitance Fund Services service mark was first used in the U.S. in 2012. Okay. Now, there have been some key legislative changes that affect this product and this process. We talked about the 506C allowing public solicitation of this type of product. All right, so that's huge from a marketing standpoint. That relates directly to the level of fundraising that can be accomplished. And with the new tax bill, we talked about the new territorial tax system, which allows these funds to now have foreign subsidiaries without having double taxation. Okay, so that's huge. So our rollout for this product is slated for this year. We're currently early in the year. Pasterra Funds service mark will first be used in 2018. It will brand the Latin American finance funds. All right. We'll reserve the service mark with the U.S. Patent and Trademark Office for commercial use. All right. So there's a lot to look forward to. There's a lot we can do. We can really make a mark with this product. So here's the timetable that we're looking at for rollout. In months 1 through 6, we're looking initially for $350,000 initial seed capital to establish a base of operations in Panama and Central America. Okay? We'll talk more about that in a minute. Within 12 months, once that initial platform has been established with the collateral, marketing material, infrastructure, and everything needed, then we feel that we'll be in a very good position to attract our first fund sponsor with $2 to $4 million put into developing the new fund, the first fund, and from there it's off to the races. Okay. Having done that, within the first 5 years, we're looking at creating and developing multiple fund sponsors and partners on an annual basis to start using the Pasterra funds in the U.S. Okay? So again, for clarity, we're talking about Latin American businesses setting up a fund in the U.S. to generate fundraising, which can then be used to provide the Latin American client who has purchased a license the opportunity to generate low-cost, long-term financing for their specific projects or business development. Okay? And right now, the Panama Company is authorized to manage loan portfolios on behalf of U.S.-based Pasterra Funds. Lending and investment operations may be carried out by licensed offices specializing in the local partner's expertise. Okay, so for example, if you were to be a local partner, the structure could be established to cater to your needs, goals, and objectives. That's what we're trying to say. All right, so the initial gestation, inception, and prototypes have already been accomplished. We're in phase 2 rollout right now. The $350,000 seed capital for the Central American platform would represent 10% equity in the operating company, all right, to offer the licensing of Pasterra Funds capital to third-party clients, all right, and this will help secure phase 3 investment partner, which would be $2 to $4 million, which I mentioned just a minute ago. Okay. The Panama operating company is targeting 2 fund sponsors, 2 to 4 actually per year, and the license fee would be roughly $1 million on each. Okay. Put it into perspective, to raise, $200, $300, $500 million, that's just cost of doing business. All right. Now again, investor options may select an early exit strategy, which could be triggered by the first sponsored fund reaching $10 million in bond sales and being in full operation, or it could be a fixed return. All right. Either way. And so this seed funding is going to provide for the corporate structure, hiring the first sales consultants to market to fund sponsors, collateral marketing material, establishing a market presence for the Pasterra Funds with all the needed materials to acquire fund sponsors, market research and consulting on both institutional and venture capital investors. All right, this will provide operating expenses for a year, and it will pay for first-level license with Avitance Global Consulting to be able to represent this patentable technology and bring it to market. Now, an ideal investment partner might be one who has capital gains experience and some knowledge of the financial markets, who perhaps understands the lending business related to companies in both debt and or equity ventures. All right, our partner may possibly qualify to be invited to the board of directors if that's a desire and a value. And of course, being bilingual in Spanish or English, if they're going to be actively involved, would certainly be a big plus. Now, these are ideal standards, and we certainly understand that there's always going to be room for flexibility depending on how involved a partner might want to be, or if they just want to maintain a relatively passive position. That's all on the table. Okay, we can discuss the needs as they arise. So looking at target revenue and return forecasts in the first 5 years, we're looking at creating anywhere 2 to 4 funds per year. 2 is very low, I believe. I think 4 would be a much more reasonable figure. 1 every quarter, that's 1 every 3 months, to have a client and be moving forward with that client. So year 1, by the end of this year, we expect to have at least 1 in process. Every year thereafter, let's say 1 per quarter, 1 every 3 months, with specialized, insightful consultants, tapping into a very select clientele base that it's out there. And when you look at the market for capital, that well-designed, well-managed projects have such a hard time when credit is tight, and it's just difficult for many reasons for projects to get the funding they need. This is a way for them to help generate their own funds. So the market is there, and I think one per quarter is a very reasonable figure for us to look at based on the acceptance in the market that we've experienced already. Okay, so that's just based on experience. So each fund client will pay $1 million minimum in cash or note. That note may be monetized with the first Pasterra fund. That's an acceptable transaction once we have that fund set up, and that could be the initial payment for the sponsorship arrangement. All right, so in our revenue model, we're looking at $4 million a year in upfront license fees. That's 4 fund licenses. $5 million a year in residual fees after years 3, 4, and beyond. Okay, there are residual fees that are involved in this as the funds continue and grow, and that creates a very interesting opportunity. Of that $9 million, $2 million will be in revenue sharing that will go out to Habitants Global for their support, assistance, and basically they'll be the ones setting up the funds in collaboration with our Central American platform. Okay, so we can talk in terms of having a target of $7 million in sales revenue per year based on this model, based on these given figures, starting in year 3. And typically companies are valued on the basis of forward-looking cash flow. And so using this model and a 5 times profit earnings ratio as a minimum corporate roll-up value. Okay? So 5 times 7 is roughly a $35 million company value. 10% equity, do the math. Okay? So in summary, QTP Panama provides for a minimum buyout return rate of 20% per year for the $350,000. All right. Or again, we can talk in equity participation. So what makes you comfortable there? So a projected valuation of $35 million for the company would be very realistic, and using this conservative model's given figures for the later years, 3 to 5 of the forecasts, $350,000 investor may see a $3.5 million value for his investment, or take a simple 20% annual interest and early exit buyout. Okay, so that's what's on the table. Should be quite attractive and makes simple sense, I think. All right, now the opportunity for a partner or investor for the initial $350 also includes potential active involvement, and that would include, related compensation over and above, the passive participation. All right. So that's a factor to consider in overall compensation if one might be inclined to be more active in the company. All right. So the offer is dependent upon several variables to be determined by discussions and to the desired level of participation, involvement, exit strategy, goals and objectives. Those can all be discussed and hopefully a reasonable solution brought forward to everyone's satisfaction. If that is of interest, we foresee the commitment process to be very simple. A simple letter of intent or term sheet be agreed to. Funds would be put into escrow, and the business plan would be put into effect. Funds would be released from escrow on a step-by-step basis as the company is put together and organized in such a way to be market ready. All right? So with that, that's all I have for you for now. Hopefully, we've generated some level of interest. This is a very unique opportunity, a very potentially profitable one, we believe, and we thank you for your interest. All right, so I would simply suggest get with the person who shared this link with you, this presentation, and we'd be happy to arrange a follow-up session to drill down on some of the details and take it a little bit further. All right, so with that, thank you, and have yourself a wonderful day and week ahead. All right, hope to talk to you soon. Bye for now.